welcome everyone who's joining. We're just letting people join. We have so many people registered. We want to make sure everyone gets into the webinar before we start. So thank you for your patience.
Okay, hello everyone. Welcome to the Lab's Demo Day. We are very excited to have a global turnout today, and we are honored to have you here. Before we start, a few housekeeping items. This event is live on YouTube and the recording will be available afterward. We will share the link with all of you who are registered. And today you watch a series of presentations from climate finance innovators who have been through the Lab program in 2022. After each presentation, there will be a Q&A segment. If you have questions, type them on the Q&A feature on Zoom. Not the chat, but the Q&A. You'll find the icon on the toolbar at the bottom of your screen, and you can also upvote your preferred questions to let us know which ones you'd like us to prioritize. Our goal today is to answer all questions, either verbally or via text. Each team has a designated person answering questions in real time. But given time is limited, teams will follow up via email for anything we can't get to today. So we encourage you to continue the conversation. If you're watching it live on YouTube, use the comment section to type your question. Our team is there too. And now let me introduce our hosts today, Barbara Buchner and Vikram Wej from CPI, the Lab's Secretariat. Barbara is our Global Managing Director and Vikram is our Senior Advisor. Barbara, Vikram, take it away.
Thanks so much, Julia, and thank you all so much for joining us today for the third Lab Demo Day. It's really always a pleasure to showcase what climate finance entrepreneurs have come up with during the Lab Incubation Program for Innovative Sustainable Investment Ideas. And it's a pleasure as well to co-host this webinar again with Vikram Wej, CPI Senior Advisor, and someone who knows the Lab very well since its inception. So hi, Vikram.
Hello, Barbara. The pleasure is all mine, always when it comes to the Lab for sure. And I'm looking forward to showcasing this Lab class of 2022 alongside you. So today we are proudly going to present a cohort of very diverse, innovative financial instruments that focus on climate adaptation, sustainable food systems, zero carbon buildings, sustainable energy, and nature-based solutions. So all the hot topics of the day. And these instruments together could mobilize over $2 billion in climate investments in the long term. So
yeah, that's well noted, Vikram, and I think really important, but it's essential that we also contextualize these figures. And as you can see on the graph on the left, global climate finance flows reached a little over $630 billion on average over 2019-2020, which is the latest period where we have complete data. And we've seen growth slowing down compared to previous years. And while public and private actors have steadily increased their climate investments in the last decade, numbers are still far behind what we need to have to meet the climate objectives set for 2030. At this point, it's clear that incremental increases in climate finance will not be sufficient. Finance flows need to increase decisively, and they need to be redirected from high carbon investments, and they really need to be counted in the trillions, not the billions.
Right, indeed, Barbara. And we can't get to the trillions of dollars needed in investment from just governments and public finance, support from philanthropy. The private capital has to be included as part of the solution and must be mobilized. So with this objective in mind, the Lab was created in 2014, seeking to identify and develop a myriad of innovative financial mechanisms that can attract private capital into climate change mitigation and adaptation, all focused on developing countries. And the idea, of course, is that these solutions use small amounts of grants and concessional capital, now more or less called catalytic capital, to kickstart these operations and then grow into self-sustaining instruments that are able to create significant impact at scale while also achieving commercial viability.
Yeah,
So,
and the lab
yeah,
success
the graph is up. So the lab success is based on three key pillars, right? The first is that there's a strong collaboration between public and private sectors. The second is to try and crowdsource and openly source concepts worldwide. And the third is having a powerful network of financiers and policymakers to move these solutions into action. And so far, I have to say, it's been working pretty well. I've been involved from the inception, as you said, and this group represents the 8th annual lab cohort that has worked on ideas like this to tackle critical climate change related issues.
8 years, it's pretty impressive, yeah. And indeed, I think one of the biggest reasons it has worked so well is that its unique structure really brings together a diverse group of stakeholders to the table to help develop these ideas. The lab has grown to a member-supported organization of more than 70 governments, development banks, philanthropic organizations, and private sector experts who actively contribute to developing each year's selected ideas. And for me, this membership, this network really is the backbone of the lab.
Yeah, and it is absolutely critical because all this effort, obviously from the lab's secretariat, but also these cohort of advisors that we have in the network has resulted in the creation of 65 new and innovative financial instruments that, as I said earlier, address both mitigation and adaptation, but also operate across geographies and in some of these most critical sectors that are ultimately going to be key for a sustainable economy and a just sort of transition.
Yeah, and I think what is really important is to look at the impact of the lab. Together, these instruments have mobilized over $3.3 billion in climate investments, with some sectors achieving scale faster and attracting more capital. And close to 47% of those finance flows come from private sources, while about 50% comes from public sources and 3% from philanthropy. And I think these numbers demonstrate the benefits of public-private collaboration and show how the lab has been effective in mobilizing private capital. But it also highlights how important the catalytic role, as you just called it, Vikram, catalytic role of public finance, of concessional finance in unlocking commercial investment has been. So after 8 years conducted, the lab has now an active portfolio of about 50 instruments, which represent about 80% of all the instruments that have been developed over the years. And also it has a funding rate of about 54%, which is a much better rate than other incubators in the US. And I think this is reflecting a very healthy balance of innovation and success.
Go Lab. We will soon get a chance to hear directly, of course, from all the new sort of cohort of entrepreneurs of this lab cycle of 2022. They're going to present the opportunities that tackle some of the most challenging, if you will, issues of our time within the broader climate investment space. We have 7 instruments that are going to pitch today, which together represent the latest innovation approaches to sustainable investment. Over to you to set the stage, Barbara.
Thanks so much. And yes, and these instruments also kind of span over 3 continents, with 4 instruments aiming to tackle climate issues in sub-Saharan Africa, 2 in South and Southeast Asia, and 1 in Latin America. But not only are they diverse in terms of geographies, but they also vary in relation to financial innovation and impact focus. Together, the proposed solutions will address 14 of the 17 Sustainable Development Goals, with particular emphasis, of course, on SDG 13, climate action, but also on SDG 8, decent work and economic growth, and SDG 17, partnerships for the goals.
So, as I said earlier, these ideas could potentially mobilize over $2 billion in the longer term. But today, to get them off the ground, we are presenting a total of $473 million in immediate fundraising opportunities that are split between grants, concessional capital, and commercial capital. So at the end of the presentations, we will send you a poll or where you can express interest in hearing more or engaging with the teams around the specific instruments. So please stay with us. Please reach out if you see any potential for collaboration. And with that, over to Barbara for the first instrument.
Thanks so much, Vikram. And yes, please stay with us. We really need you to make sure that these instruments get to the next stage. But with that, let's now finally move to the first instrument of the day, the Green Guarantee Company. And Lafita Pereira, the CEO of the Development Guarantee Group, will walk us through their solution for the issues concerning green bonds in emerging markets. With that, over to you, Lafita.
Thank you, Barbara. So as Barbara said, my name is Las Pereira. I'm the CEO of the Development Guarantee Group. The Development Guarantee Group is the world's first dedicated guarantee platform. And what that does is it brings together some of the leading experts in the design and development of guarantee solutions and companies focused on emerging markets. Could we go to the next slide, please? Thank you. So, oh, no, too far ahead. One back, please. So this slide shows the companies that we as a team have scaled over the past decade. And I'd like to point out our institutional shareholder, which is Cardano Development. Cardano Development is a specialist incubator of innovative solutions for financial markets development. They worked in emerging markets for over 15 years, and they have about $3 billion of capital under management. The senior management team, of which I'm part, is focused on developing the Green Guarantee Company. We have experience of setting up and scaling 6 guarantee companies focused on developing markets, and we have a broad range of experience in terms of what we bring to the table, around from both operational risk all the way through to transaction origination. So, what is the problem that we want to try and solve to the Green Guarantee Company? So the United Nations has identified the climate finance gap for emerging markets as being around $5.9 trillion. $5.9 billion. However, the local capital market emerging markets only have 1.7. I think this is wrong. It should be trillion here, but let's say so change the billions in your mind to trillions here. So it's 1.7 trillion versus a gap of 5.9 trillion. But what fundamentally we're saying here is that even if we mobilize every single dollar in emerging markets, it's still not enough to meet the climate finance gap. So we need to be bringing the development capital markets with their over $100 trillion of assets to the table. Now, the global climate finance market has been growing exponentially over the past decade. However, if you look at sort of the dark green segment in this, which represents the growth of the emerging market, green bonds, for example, it hasn't really been growing as a percentage of the overall market. It's been relatively static. Now, one of the key reasons for that lack of growth in climate finance from developed capital markets to emerging markets is what we're calling the credit rating barrier. Now, the majority of capital in developed capital markets is only available for borrowers with investment grade ratings. However, most of the climate projects in emerging markets are rated below investment grade. So they have limited access to the climate finance that's available from developed capital markets. The Green Guarantee Company hopes to address this issue by providing investment grade guarantees to investors to encourage them to invest in climate projects in emerging markets. The guarantee covers any risk of non-payment by the climate project, thereby improving its credit rating to investment grade and making it a much more attractive investment proposition to global investors. The Green Guarantee Company will focus on both climate mitigation and climate adaptation projects. We have successfully achieved recognition by winning 2 global competitions for climate finance ideas, including the lab. And in addition, one of the key things that we will do, which will generate market transformation from our perspective, is we're also going to provide specialist reporting services to investors. Now, the purpose of doing this is to help build the capacity of these investors to understand the actual risk they're taking on the ground. Now, over time, what we're hoping is that that capacity, as it builds, will enable them to invest without the need for guarantees. Aside from this market transformation, the Green Guarantee Company offers a lot of attractive returns to its shareholders. It has the ability to continuously recycle its capital, thereby providing guarantees, which means it can multiply its catalytic potential significantly. It also has the ability to offer commercial returns on investment. It's able to offer significant climate impact, and its cross-cutting nature means that it can actually address multiple SDGs at the same time as well. All of this is underpinned by a very highly experienced management team with a strong track record of delivery. So There is, however, still one final step that we need to take to be able to make the Green Guarantee Company operational. We have achieved many significant milestones over the past 12 months. And what that does is putting the Green Guarantee Company just months away from being operational. It's able to be highly scalable. We've achieved an indicative credit rating of BBB, which allows us to leverage our capital 10 times. And this ability to scale the Green Guarantee Company means that we also have the opportunity to consider publicly listing it at some point in the future, so thereby offering an exit route to our investors. So this final step that I mentioned, well, we're looking for $20 million to help us bridge the gap and achieve our first close of $100 million. We're able to then leverage that $100 million by 10 times to provide $1 billion of guarantees. We're currently working with our two anchor investors, the Green Climate Fund and the UK's Mobilist program, helping to try and secure the $80 million of commitment that they've given us in principle. Having sight on this last $20 million is going to be a key part of that process with them. So what we're asking from those organizations listening in today who are able to make equity investments to please consider the Green Guarantee Company and reach out to us. We have the ability to consider aggregating equity investments. So no investor is too small for us. And we're looking for everyone to come together and help us bridge the gap. So I'm going to stop there for now, but thank you very much for your attention. And I'm happy to answer any questions you may have. So look forward to hearing them.
Great, Lars, thank you so much. And thanks for a really great overview and also showing the track record that you have. We already have a couple of questions. I can see Dale replying to one of them from Charlie, and it's great to see you online, Charlie Barker, on who will underwrite the risk. And then there's another a very good question from Jennifer Wong on what types of instruments do you guarantee? So let me just pass it back to you and see whether you want to have a go at those.
Sure. So what kind of instruments will we guarantee?
What type?
Question?
Yeah.
Type, yeah. So we'll guarantee any type of debt instrument. But one of the key conditions is that that debt instrument needs to be sold to institutional investors. So we're working with 5 origination partners, which are 5 global banks. And what we've said to them is they can bring transactions to us, which are bonds, loans, private placements even. But a key requirement is that they will ultimately have to sell those debt instruments to institutional investors, because what we're trying to do is grow the market in terms of climate finance for emerging markets. So we want to bring new investors in who typically wouldn't have considered emerging markets as a destination for them without a guarantee.
Great, thanks so much. And not sure whether Dale, you want to just also elaborate a little bit on your reply to Charlie on who will underwrite the risk?
Yes, no, of course. So essentially, the Green Guarantee Company is writing this guarantee, and it's using the capital that's invested within it to actually write that guarantee. Because the Green Guarantee Company will have an investment grade rating, it's able to leverage its capital 10 times. So on first close, we'll have 100 million of capital. That gives us a $1 billion worth of capacity to write those guarantees with.
Great, thanks so much. And I think maybe just one last very quick question from me, and then we move on. I think more historically, we have seen that guarantee facilities have sometimes failed on expectations to catalyze private capital at scale. So just understanding a little bit your take on why is this one, the GGC, why is it different?
Well, I can't really comment on why others have failed, but what we believe we bring to the table is the team and the experience of Cardano development. We have set up, as I mentioned, 6 guarantee companies and successfully scaled them. I was previously the CEO of Garanco, where we scaled that to $1 billion. One of our partners, Buhok Ko, used to run the guarantee arm of the Asian Development Bank and has scaled that to several $1 billion. So we have a lot of experience in doing this at scale and working with capital markets as well. So we hope that will set us up for success with the Green Guarantee Company.
Great, thank you so much. And thanks, Abid, another lab member actually from Bank of America, also for another question. The team will reply to that in the chat, but I will hand over to Vikram to move us to our next instrument. But thanks so much for the overview and all the work, Lasita and team. Thank you.
Thank you very much, Barbara, Vikram. Thank you.
Great. Yeah, thank you. Thank you, Barbara. Thank you, Asita. So next up, we have the Climate Insurance Linked Resilient Infrastructure Finance, or CILRIF, instrument that's going to be presented by Abhishek Dhawan, who is the Sustainable Finance and Partnership Specialist and the Corporate Lead on Climate Change at the UN's Capital Development Fund. He's going to present their proposal to build climate resilience at the city level. So the floor is yours, Abhishek.
Thank you very much, Vikram, and it's a pleasure to be here. Let me start by, if you could go to the next slide, please. The challenge that CILRIF is trying to address. As we all know, cities are often at the front line of extreme weather events, and we have seen a few of them happen this year. And there are significant barriers that keep them from adjusting to risks that they encounter and incur. The first is the lack of liquidity. So when a city gets hit by a climate event, they need immediate liquidity to respond to such a crisis situation. The second barrier that comes then is they are taking away, if you could please, is the budget from future development that goes into taking care of the immediate liquidity needs, which means that the cities are significantly impacting their future development because they will have lack of financing. And that's sort of the third barrier that CILRIF is trying to address, where cities have, especially in emerging markets and least developed countries, have lack of access to financing. And finally, the barrier that cities have in general, why they cannot invest in resilient infrastructure, is because they have lacked all of these issues of lack of financing, high cost of financing, etc. Next slide, please. So what is CILRIF essentially trying to do? CILRIF is trying to create a long-term insurance that will promote resiliency. And let me explain how that works. When a city has access to long-term fixed price climate insurance, when the city gets impacted by a climate event, they get immediate access to liquidity, which means that they do not need to reallocate budget from future or current cash flows towards recovery from such an event. However, what CILRIF is insisting on when the cities buy these long-term climate insurance is that they should be willing to commit to investing in resilient infrastructure. And when they do so, CILRIF will ensure that their premiums that they have to pay, the insurance premiums that the cities have to pay, reduces when those investments are made. And CILRIF at the same time will also adjust the cost of financing that CILRIF provides to the city when CILRIF sees that the city or the institution sees that the city has made those investments in resiliency. Next slide, please. So how it works. CILRIF has a technical assistance and a subsidy facility that helps cities adopt the CILRIF approach, which helps cities secure funding for building capacity that will be required for them to deliver on a CILRIF approach, which means that the cities will understand what their risks are, what kind of resiliency interventions they need to make, and put in place an organizational structure that can deliver on that. CILRIF then comes in and issues a long-term insurance product to the cities at a fixed premium, but agrees on what the resiliency investment the city will be making. CILRIF also provides financing by purchasing municipal bonds or providing loans to the cities, and then restates the cost of those financing instruments when the city has made investments in resiliency. Next slide, please. Where is CILRIF right now? So we did our research and analysis, and we've been working with insurance companies and investors over the last 2.5 years. And we started a couple of pilots and started some of the modeling elements. And SILRIF right now is in between pilots and modeling and scaling up. Next slide, please. Next slide, please. So what does SILRIF attempts to achieve is promote climate adaptation, is a very data-driven and science-based approach towards climate adaptation, because we are able to measure the risk that the cities face and the cost of resiliency as well, which essentially means that we are starting to put a price to climate risk. SILRIF also mitigates inequalities as well as helps facilitate access to capital for the cities. Next slide, please. SILRIF has impact like most other instruments in today's presentation, impact across SDGs 6, 8, 9, and of course 11 and 13, which is climate action and sustainable cities and communities. This has been a very powerful collaboration across industries, which includes experts, insurance and reinsurance companies, engineering firms, academics, development agencies, and investors who have been contributing towards development of the SILRIF approach. And we want to especially thank the CPI's process this year, which has helped us set up what will look like as a fund structure for SILRIF. Next slide, please. And I have been very fortunate to work with a group of volunteers who've been supporting me in putting this together. My background is work for about 20 years in international markets and financial services, including in financial markets. And I think that's the experience that I bring to the table with this team to put this all together and deliver on it. And the UN ecosystem can really help bring together public and private sector, and UNCDF has this unique ability to work with the private sectors very closely. Next slide, please. So what are we looking for today is the grant seed capital for the technical assistance and subsidy facility, which will help us to start preparing about 25 cities across emerging markets to adopt the SILRIF approach. We have already run an expression of interest process, but we have also identified partners who are working with some of the cities who've been part of our working group, like ICLE and C40 cities, with whom we will work together to deliver on SILRIF's promise. So we're looking for $20 million to help set that process up. Next slide, please. This is something that one of the pilot cities chief of planning section has to say about SILRIF, where they have been able to integrate, harmonize, and see the different aspects of the data, which will help them understand their own risks and the mitigants that they need to put together. Thank you very much for your time.
Thank you so much, Abhishek. That was, I'm looking at the, we have a question. Sorry, just a couple of quick, hopefully we get you a couple of quick questions for you. There's a question from Jennifer Wang. Is climate insurance already a thing that cities buy? Interesting question, because we've struggled with it on a couple of different fronts. You answer that, and I might have a follow-up question, but I encourage others to type in. Go ahead, Abhishek.
Sure. So cities have been known to buy insurance, not necessarily climate insurance across. They have been buying risk insurance. So for example, Makati City has bought insurance against earthquakes. And so when they saw this approach on climate insurance, they realized that they are exposed to climate exposure, and they are willing to, that's why they have been part of the pilot process. What we also know is that globally, climate insurance is mostly being bought by homeowners per se. However, what we realize is that since cities and municipalities are responsible for recovery from extreme climate events, they have a lot at stake when such events occur. and they do anticipate the cost of rebuilding is going to go up, and they believe that this approach can help them mitigate the cost, but also sort of flatten out the cost over a period of time, even if it is so the impact of immediate recovery doesn't happen on a particular year when the event happened, but with the insurance they can spread it out over a period of time, and I think that's why they are interested in this.
Right. And, it's challenging, we know, but, I guess that's why you may be focused on heat and flood risk. But, why those two compared to other physical risks? Perhaps because that's more immediate?
Well, it's two things. One is, yes, it is immediate and it's more visible right now across the world. But the second is that the climate scientists from Columbia University and other experts who've been part of our working group have also realized that these are the two risks which we are in a better position to model and price. So it's a mix of those. These are events that are happening, but at the same time, we have better ability to model them and be more accurate with these two risks. And I think that's why we decided let's try to use not the low-hanging fruit, but the less difficult, challenge.
And create a current theme totally. So good luck with that, Abhishek. Thank you for that, and good luck with the initial funding to get the pilots going. We're going to move on to our next instrument, and that is from our India stream. It's called the Financing Steel Decarbonization, clearly a topic of much interest to many. And Abhijit Basu, who's the founder and keeper of the purpose of SmartX, I like that title, is here today to talk to us about how their solution is going to help India's steel industry to start with transition to a low carbon pathway. Abhijit, over to you.
Thank you, Vikram. Greetings of the day to everybody. I just posted a link on the chat as a recent announcement as of yesterday, our MOU with JSW Group, which is one of the largest steel producer out of India. I'm Abhijit Basu, founder of SmartX. SmartX is an enterprise and environmental technology company. My co-proponent on this instrument is Mark Ruth from National Renewable Energy Lab. Financing steel decarbonization is first of its kind climate impact and return-oriented mechanism targeting hard-to-abate industry like steel. By providing a technical assistance facility, technology debt fund, which is blended, and finally creating an ecosystem to support the transition. It is based on our homegrown framework, Business, Technology, and Humanity, which is primarily to address not only Indian market, but cross-geography and cross-industry beyond steel. It is actionable and accountable to deliver impact by de-risking for technology, capital, and market connectivity. Next slide, please. So we have a team that covers the entire gamut from building a business to decarbonization. We have steel experts to regulatory monitoring experts on our team, and soon we'll be adding fund managers to develop the instrument. So just to anchor the thought, if you are targeting a hard-to-abate industry, you have to think about 5 C's and an A. Primarily, these are capital, carbon, and complexity intensive. They operate in highly price competitive commodity markets, and they are consumers of technology, off-the-shelf technology, and not innovators. Now, there is another challenge, which is the accountability of impact, which we are targeting as well. But the bigger challenge that we see is a serious catalytic capital is yet to focus on hard-to-abate industry. And that is what exactly the decarbonization mouth is. So in order to address these challenges, what we have done is we created 2 financially and legally separate entities. Steel Decarbonization Fund will address the access to patient low-cost capital with a technical assistance fund, and a decarbonization technology fund. While SDI is a service company that will support the transition of industry with help of technical assistance as well as clarity on technology pathways, and etc. So SDI will also be responsible for monitoring, verification, reporting of impact performance to all stakeholders transparently to address the A of the challenges, accountability. Next slide. So there are traditional barriers and there are climate investment barriers. Again, SDF will address the unsuitable capital risk return profile by providing the patient low-cost capital, and SDI will take care of the technical assistance execution and figure the clarity on technology pathways, figure out the offtake agreements for price support, and help develop an enabling ecosystem for impact accountability. Next slide. So how does this instrument works? So primarily SDF provides the TA facility for SDI to execute it along with the industry. Once the pipeline is ready, SDF actually funds just the incremental cost of risk technology, while the rest of the infrastructure and plant will still be funded by capital markets and the sponsors' equity. Now, SDI also takes care of the techno-economic analysis, the business modeling, if insurance is needed, and monitoring services for a fee. SDF and SDI are mutually reinforcing entities to actually provide the necessary support to make sure the transition of industry is profitable and the society is equitable. This instrument has an immense potential to provide sectoral, environmental, and societal impact. It's targeting 20 to 30 million tons of decarbonized steel per annum, with 25% reduction in carbon intensity and 250 million tons of carbon reduction over lifetime. The cost of abatement is around $2 concessional dollars, and it promises to mobilize 7x of commercial capital. Along with that, it also targets SDG goals from partnership building to ecosystems to inclusivity and gender equality. So as I mentioned, the work is on, and we just closed MOU with JSW Group to look at 3 carbon capture and 1 hydrogen project. There is another greenfield project with another steel company that is being discussed, which is going to be at a cost of $1.2 billion. So there is a strong TA pipeline that is building up. So we are going to set up the 2 entities in the next 6 months, figure out the grant process to fund the TAs, to create the pipeline and execute on them. In the next 2 to 3 years, our goal is to raise equity for SDI to help it focus on TAs and building the ecosystem and the market, while SDF will raise the first 200 million of rolling funds. In phase 2, SDF will scale to $1 billion while we commercialize the technologies that we built under SDI umbrella. And finally, phase 3 will explore other geographies and industries, while SDI will raise serious equity to expand. So today we are raising $20 million in grant capital, 98 million each in concessional and commercial capital, and finally equity in SDI in $18 million. So we are on this journey to decarbonize, to cross the chasm of decarbonization and inclusivity by keeping the industry profitable and society equitable. We welcome you to join us, and thank you for your time. Thank you to the lab and industry, players like JSW for supporting this instrument. Thank you.
Thank you, Abhijit, and congratulations on at least having a potential sort of steel company sign up. So good luck with that. I'm going to combine a question with it got answered already, so then it's fine. There was a question around technical assistance. Well, so it seems yes, it'll include capacity building and knowledge sharing. So thank you, Sagar, for that question. You put up some estimates around the different types of capital and the use. Do you have any? Since there was a question on TA, do you have any estimate on what the cost of TA may be for preparing these sort of low carbon projects?
Sure. So we already have almost 35 crores Indian rupees TA being discussed with JSW Group. So we have estimated it will be around 5% of the $1 billion fund over a period of 5 years. So that comes out to be approximately, I believe, $50 million, and that's what is estimated. But we are going to raise grant for $20 million, but rest of the $30 million will be funded by business operations.
Sorry, okay, not to berate it, but you said the technical assistance with JSW itself will be 35 crores?
That's correct.
Okay, so that's probably about $5 million or something.
$5 million, but the JSW would be paying 50% of it. So it's basically 50%
of that, and you'll match it, you'll raise the other.
Exactly.
Okay, great. I'm not sure we have more time, but I was told we have a little time. Just one pitch, give you one elevator pitch. What is the biggest value proposition of your project, right? Why is anybody going to invest in any of these capital tiers?
So the primary challenge with the 5 C's and the A is that you need an end-to-end de-risking of capital, technology, and market connectivity. So we are providing not only the fund, but the technology assistance and also price support for the additional cost of steel. So we're taking the end-to-end approach on this, which is why JSW Group decided to join us.
That's fantastic. All the best, Abhijit, with JSW and beyond. Thank you again. And over back to you, Barbara.
Great. Thanks so much, Vikram, and thanks so much for the presentation of the last 2 very interesting instruments. You can see that we are going to the hardest sectors, and we continue this journey now with our next instrument. And so let's learn about the methane capture service from the lab Brazil stream, and welcome Luisa Erbalon Pentato, is the Chief Executive Officer of Blue Methane. So we look forward to hearing about your solution for methane capture in the hydroelectric sector. The floor is yours.
Thank you. Good morning, good afternoon. I'm Louise and I'm CEO of Blue Methane. And together with Open Hydro, we're the proponents of the methane capture service. Blue Methane is developing technology to measure and capture methane emissions from water. And Open Hydro, with an extensive network, are mobilizing capital and accelerating climate action in the hydroelectric sector. Combined, this team has 3 pilots confirmed for the deployment of the methane capture technology. We have a track record of engagement with hydropower owners worldwide, and we're leading the frameworks on climate mitigation and resilience for the hydropower sector. It's no surprise in saying that methane is harmful. Its global warming potential is significantly higher than carbon dioxide. And methane is more damaging than carbon dioxide in the first 20 years after emissions reach the atmosphere. So methane is essentially setting the pace for near-term climate change. When I say methane, you probably think oil and gas or even cattle. But there's a lesser known source of methane emissions. Bodies of water emitting methane without getting very much attention. Although most hydropower has a very low carbon footprint, some hydropower reservoirs can emit significant amounts of methane. New methane capture technologies are becoming available, but limited financing mechanisms are preventing them from scaling. Brazil is the second largest country in the world in terms of hydropower capacity. Much of the world's hydropower is located in the tropical zones. And we know that most methane emissions are often high in those tropical areas. And that's why Brazil is our first choice for this market. Despite emerging climate technology, these companies bringing these technologies to market have not found a way to make the opportunity attractive to investors. Which is why we're so proud to present the first methane capture as a service. It unlocks investment into methane capture technologies in hydropower reservoirs across Brazil because it enables hydropower operators to adopt the technology, but without incurring the risks associated with owning the technology. And it provides short-term stable and tangible revenues using the methane captured to generate carbon credits and energy. And it reduces emissions from a previously unaddressed carbon source while increasing electricity production. Let's have a look and see how it works. Blue Methane will measure and monitor the methane emissions and supply the methane capture technology. Our instrument is centered around a special purpose vehicle led by Open Hydro, which manages the methane capture and the biogas assets. The hydropower operator will provide water usage rights and host the project on their sites. Our special purpose vehicle generates revenues from the energy sales and from the carbon credits. Bringing more than one technology together in a hybrid project has been proven before to be successful. We see it in projects like floating solar on hydropower reservoirs. Our project will increase clean energy electricity production at hydropower reservoirs whilst meeting companies' climate targets. At scale in Brazil, this instrument has the potential to reduce the equivalent of 6.8 million tons of carbon dioxide, while also improving access to clean energy and creating jobs. We will start by proving the concept at a single location at a cost of $6.5 million. And then we're going to move on to proving the business case. This will require $54 million to capitalize the special purpose vehicle to finance those 5 installations. And then finally, we're going to move on to scale up of the portfolio to a potential market of over 250 projects in Brazil. To deliver this, we are asking for $6.5 million in grants to prove the concept. And whilst we have you, our great climate impact audience here today, we're also looking for an advisor in carbon credit pricing. So thank you in advance to anybody who can make an introduction to an expert in that area. So thank you for joining us today. And I'm going to share the floor with Maria from Open Hydro, who's going to answer your questions.
Great. Thank you so much, Louise, and welcome, Maria, as well. And thanks so much for the overview. And I think I fully agree with you. I think we've at CPI done very recently a report on methane finance, and we see that there's like only about 2% of current total climate finance flows are going to methane abatement measures. So we certainly see that there's a real need to scale that and increase that. I currently cannot see any questions from the audience. Please keep them coming. But I think as we are waiting, I have a couple of questions. I think particularly asking you about the technology and just understanding to what level this technology has already been developed in other of the pilots, like several of the pilots that you've mentioned. So is there any specific evidence that you have on the technology here?
Yeah, we are deploying our proof of concepts for the technology at 3 locations over the next few months. One's going to be in Lake Kivu in Rwanda, one like to be in Colombia, and one in Poland. And we've tested a small prototype at a water treatment plant in the Netherlands. But the instrument will take us to TRL, Technology Readiness Level 8.
Okay, thanks so much. And I think this is also answering the question from Siva on whether there's any operational project up and running in Brazil. So I think that already answers it. But we have another question from Adit Kamali, who's asking, in your base case, what is the split of revenue between the energy sales and the carbon credits? So basically, whether you're assuming the voluntary carbon market or the Article 6.2 carbon credits, the international carbon market.
Yeah, maybe I can answer this. Thanks for the question, and this is very important. So there are two streams of revenues for the service, and one is energy sales, another is carbon credits, and they are equally split. So it would be 50-50 in these theoretical in theoretical calculations. That's why we also need a proof of concept, and there can be variations to that, because of course the carbon markets can be volatile for the price set for the carbon credits, and likewise, like when we get the power purchase agreement, for example, for the energy sales, but more or less would be 50-50%.
Great, thank you so much. That's very helpful. Okay, if there is no other questions, and I think you've been very clear, Louise, and again, very excited to see, as this proof of concept comes together, and then really trying to see how that can be applied across different regions, also besides Brazil, which you're already doing. So thank you so much for being with us, and looking forward to the next development here. And with that, Vikram, I'll hand back to you.
Great, thank you, Barbara. That is a exciting development in terms of trying to get access to carbon markets to do something interesting and different. And we all know methane is an important short-lived pollutant that needs to be addressed quickly. But now let's hear from the Climate Smart Shrimp Fund that will help with mangrove restoration and the construction of sustainable food systems. Music to the ears of those like me who love shrimp and are very concerned. So for this, we are going to welcome Dane Klinger, Director of Aquaculture from Conservation International. So over to you, Dane. Thank you.
Thank you. So I'm going to talk about the Climate Smart Shrimp Fund, which is a unique instrument that enables improved farm productivity and mangrove restoration, a win for farmers, the environment, and investors. Next slide, please. Climate Smart Shrimp was set up to overcome two primary challenges: a global mangrove challenge and a shrimp aquaculture challenge. So historically, the world has lost about 40% of its mangroves, and the main driver has been shrimp aquaculture expansion in the 1980s, the 1990s, and early 2000s. And since 1980, shrimp aquaculture has increased on average by 14% annually, and now produces about 7 million metric tons of shrimp per year. And the deforestation from shrimp aquaculture has slowed, but the ecosystem services from mangroves that were lost remain absent. At the same time, in shrimp aquaculture, the sector is changing rapidly. The real price of shrimp has been decreasing for the last decade or so, and farmers need to reduce their production costs to remain competitive. The best way to do this is to intensify their farms, but most farmers have limited access to financing and expertise required to intensify without substantial disease risk. Next slide, please. So to overcome these challenges, we developed Climate Smart Shrimp. And this approach enables low productivity shrimp farms, like the one on the left, which make up the majority of shrimp farms globally, to increase their productivity on the farm by modernizing a portion of their ponds and restoring mangroves on the rest. And so transforming them into the picture on the right, where you have intensive high productivity ponds on a small portion of the farm, the blue boxes in this case, and restored mangroves, the green box, on up to 70% of the remaining farm. And we think there's about 2.1 million hectares of shrimp farms globally that would be applicable for this model. Next slide, please. So this is what the intensification part looks like. The farm goes from the picture on the left to the picture on the right. And so on the left, you have an extensive, low productivity pond. The ponds themselves are typically large, earthen. They require few inputs, but they produce very, very small amounts of shrimp. And as the farm becomes more intensive, they transition to that picture on the right, where they're using auto feeders, they're using aeration, They might line the pond with plastic or concrete. They're using different types of feed. They're stocking the pond. And most importantly, they're monitoring water quality and managing for environmental conditions on the farm, but also the water being discharged out of the farm. So the farm production goes from about 0.5 tons per hectare per year to up to 50 tons per hectare per year. So several orders of magnitude increase in production. And that allows the farmer to produce more on less land, creating the space and the resources for mangrove restoration. Next slide, please. So the Climate Smart Shrimp Fund then is a proposed $100 million instrument designed to help scale the Climate Smart Shrimp approach and is made up of two separate sleeves, a direct lending facility and an accompanying technical assistance facility. And so together, these two sleeves provide a unique loan bundle to eligible shrimp farmers, providing them with the funds and the technical capacity required to intensify their operations and restore mangroves in line with the Climate Smart Shrimp model, as well as connecting them with supported off-takers. So the opportunity to work with farmers is now while they're looking to intensify, but don't necessarily have access to the financing, expertise, and markets required to do so sustainably and with low disease risk. Next slide, please. Yeah. So there are three phases to the fund. The first, which we're currently embarked on, is the pilot loan deployment phase. And so we currently have pilots under development in three major shrimp producing countries, Indonesia, Ecuador, and the Philippines. And in phase two, fund formation and execution, beginning in about a year's time, it will include selection of the fund's investment manager, securing catalytic funding to attract commercial investors, and deploying new loans under the fully scaled fund structure. Phase three includes local funder uptake and replication. And so this, which will run concurrently to part of phase two, this phase involves engagement of local funders to disseminate information about Climate Smart Shrimp and disseminate information and that expertise required for local financial institutions to deploy Climate Smart Shrimp aligned loans of their own, allocating even more investment dollars for Climate Smart Shrimp. Next slide, please. On the impacts side, Climate Smart Shrimp and the Climate Smart Shrimp Fund provide benefits to the environment, farmers, and communities, and advance multiple sustainable development goals. So the intensification part of the model provides increased profitability, increased shrimp production, job creation, and livelihood benefits, while the restoration part of Climate Smart Shrimp provides climate adaptation benefits in terms of coastal protection and flood management, climate mitigation benefits, enhanced biodiversity, improved water quality, and additional income generation for the community through ecotourism, honey, and other revenue streams. So we're currently fundraising for an additional $5 million to complete our pilot programs. And in the future, in the next year plus for phase two, we'll need an additional $5 million for the technical assistance facility and around $25 million in concessional equity in order to attract $70 million in commercial equity. The Climate Smart Shrimp approach was developed by multiple teams at Conservation International, including global and country programs. So our aquaculture, engineering, and finance teams at a global level, and our country offices in Indonesia, the Philippines, and Ecuador. But it's also been developed in collaboration with farmer groups, supply chain companies, and governments in each of these locations. So I'll end there. Thank you for your time. We'll now field some questions, but please feel free to reach out after the event. My email is in the bottom right corner. Thank you.
Rookie mistake. Thank you, Dan. I'm just curious about, perhaps there'll be some questions from the audience, but I'm curious about how intensive farming, and you provided the numbers, and it seems the productivity is 100 times from 0.5 to 50. How does that intensive farming, is it more sustainable over time in terms of, I presume, all the, for lack of a better word, all the byproducts and the management of everything else over time compared to the less intensive alternative?
Yeah, so the sustainability on a per kilogram basis of production, intensification can be more efficient when you're talking about resource use. But the most important thing as you're increasing the intensity of shrimp farming is to use best management practices that have been developed for the shrimp sector. And so one thing we've done with the fund is to require that the farms achieve environmental certifications, like the Aquaculture Stewardship Council certification, that lays out a set of practices that minimize potential environmental and disease risks for the shrimp farm as they intensify. And so, there are good ways and bad ways to be an extensive shrimp farmer. There are good ways and bad ways to be an intensive shrimp farmer. But as long as you're using those best management practices, you minimize your environmental risk.
So there are three questions from Kimberly Thomas, from Bruce Cabarle, hopefully I'm not mispronouncing that too badly, and from Kathal Kanati. And I'm going to sort of merge them all into one question for you. And I think basically it's all around that 100x productivity that you talked about. What stops farmers from sort of either encroaching the restoration area or taking their entire land and going 100x on their revenue? What are the incentives? And if the profitability is so high, why wouldn't they just do it themselves with some technical assistance?
So great questions, and we'll follow up in the chat on the specifics of them.
Thank you.
For the most part, the farmers we've talked to around the world have difficulty getting access to finance to intensify. It's quite risky. But we've also done a lot of financial modeling around the basic, the gray engineering approach by itself. So only intensifying farms. And when you look at long-term profitability, adding mangroves along the coast to treat water coming out of the farm, to treat water coming into the farm, to protect the farm against sea level rise and storm surge, actually confers a lot of benefits for long-term profitability. And so, there is an opportunity window now, while the farmers traditionally have had trouble getting access to finance, to use that trouble that traditional barrier to incentivize mangrove restoration. But we're also working to document the long-term increased profitability of co-locating restoration and intensification, and how that is beneficial relative to just intensification by itself.
Thank you, Dan. I think we're out of time. It would be great if you could answer the specifics on intensification, and also a question on how sea level rise and salination might affect these farms, from Ken Chomitz. Hello, Ken. Good to see you here. So I'm going to turn it over to Barbara to introduce the next instrument. Thank you again.
Thank you.
Great. Thanks so much, Dane, and thanks, Vikram. And yes, very interesting. Looking forward to the additional replies. But yeah, let's stay in the nature space. And the next instrument now is the Fund for Nature. And Kate Wharton, who is the head of natural capital at Cross Boundary, is going to tell us all about how their fund will solve a very common issue among nature-based carbon projects. So the floor is yours, Kate.
Thank you so much, Barbara, and thanks for everyone who's joined today, and of course to the lab for such an excellent program over the last 6 months. Next, thank you. So I'd like to start with why. Why are we building a fund for nature? So first, natural climate solutions are massively underinvested, receiving only about 2% of climate finance flows today. Second, the destruction of nature is the largest driver of emissions in Africa, and yet there's a $100 billion financing gap for agriculture, forestry, and other land use. Third, we're not only in a climate crisis, we're also in a biodiversity crisis. The last 50 years have seen about 2/3 of wildlife populations on average decline. And finally, and most fundamentally, people are a part of nature and depend heavily on it for their livelihoods. Who are we? So Cross Boundary has a 10-year track record of unlocking private capital in emerging and frontier markets. This will be our 4th Africa-focused investment platform and our 3rd climate fund. Our team, you can see some of the team members on the right, brings together expertise across investment, blended finance, nature-based solutions, and carbon markets. So we believe that the time is right for the Fund for Nature. Voluntary carbon markets were a $2 billion market in 2021 and are estimated to become a $50 billion market by the end of the decade. Carbon credits finally are putting a dollar value on the positive externalities created by nature. They're a key part of corporate decarbonization plans that are science-based with near-term milestones. And they're also a critical source of finance for nature-based solutions in emerging markets. Our interest in what we would like to see is for this funding to go to the highest integrity projects, both from a climate action perspective and also from a climate equity perspective. The barriers that we're addressing. So first, and most obviously, we're addressing the lack of low-cost upfront capital for projects. Today, projects are typically must sell future credits at a steep discount in order to receive that upfront financing. Now, why does this matter? One, it's simply not possible to achieve the scale necessary from corporate balance sheets alone. And second, this approach of the same organization buying credits and financing the project doesn't necessarily align incentives with the project implementers. Our goal is to achieve the highest price per carbon, not the lowest. Next, we're addressing two related issues of high transaction costs and information asymmetry between the buyers and sellers of carbon credits. We're addressing this through pioneering and open sourcing a standardized bankable offtake agreement that's designed alongside a consortium of high integrity buyers. And this is a document that we would be using to lend against, as well as open sourcing to the market more broadly. And then finally, one of the other big challenges from an investor perspective, especially for those who are new to the sector or newer to emerging markets, is that they're often looking for larger and lower risk deals. And so we're offering investors through the fund exposure to a portfolio of high integrity projects that have been de-risked by the fund through the offtake agreements and through technical assistance. Next, thank you. So the Fund for Nature will provide project level debt and will offer investors access to this portfolio of high integrity nature-based carbon projects initially in Africa. The fund structure you can get a sense of on the right will manage the fund through a simple GP-LP structure. The fund and the whole co would be capitalized with a target 60-40 debt to equity ratio. Each project will be held in an SPV in the country in which it's developed, and that is the entity to which we would be lending, backed by an offtake agreement with a reputable corporate customer. And each project, depending on the specifics of the context, will have in place benefit sharing agreements with a local community, including direct revenue share from the sale of credits. As you can tell, targeting impact in a couple of areas. First, on livelihoods is employment and income diversification for local communities who are part of the project. The ranges for the KPIs here vary greatly project to project, but at least 500 people, if not many times more, and targeting 50% or more revenue sharing with the local community through a combination of employment, in-kind benefits, payments for land, as well as that direct revenue share as prices go up from carbon credits. On the climate side, obviously climate is baked into the core business model of every project that we're investing in. Each project is estimated to sequester at least 2 million tons of carbon over the life of the project. And we're also quite focused on ensuring integrity, both on supply and demand side of the carbon market. And so we have some initial protocols and guidance that we've developed with regard to integrity. And finally, biodiversity is another strong focus. So both for life on land, life underwater, there will be the certification that ensures protection of biodiversity for the project, as well as project-specific targets. Our pipeline, so our pilot fund is targeting projects in sub-Saharan Africa. Currently, the pipeline represents about $1 million of investment opportunities. Most of those are in the $5 to $10 million range across more than 10 countries. The focus in terms of project types will be on a combination of carbon removal through afforestation, reforestation, and regeneration, as well as on emissions avoidance through REDD+ projects. And in terms of selection of projects, in addition to obviously the financial profile of the project and of the developer, and the experience and management quality of the developer of the project are also prioritizing projects that will have an outsized impact. And you can see some of the things we're looking at there. So on implementation, since the beginning of the year, we have built a strong initial pipeline, as discussed, validated the design of the fund with a wide range of stakeholders, and then conducted initial carbon regulatory analysis for priority countries. We're targeting first close of the fund late next year, and are considering a smaller initial investment earlier in the year that would be warehoused and rolled into the fund. So investment opportunity, we are targeting $50 to $70 million for the pilot fund. Of that, 40% equity, 15% concessional debt, and 45% commercial debt. And additionally are looking for $2 million of grants that would help fund startup costs and a technical assistance vehicle that will accompany the fund and support portfolio projects, particularly around monitoring, reporting, and verification of impact. I think important to say that we believe this is ultimately a commercial investment opportunity, but we do have a blended finance structure at this stage, simply because of the novelty of the instrument for nature-based projects specifically. Next slide. Thank you. That's all we've got. Would welcome any questions, and please feel free to reach out following this conversation. Would love to talk with anyone interested in investing in nature.
Great, thank you so much, Kate, and thanks for the very good overview. And I think Ken, Summit, and welcome also from me already kind of put one of the questions that I had. I think just if you could maybe elaborate a little bit more on the pipeline. So what's the types of projects in your pipeline, and what's your approach in assuring permanence of carbon or biodiversity gains? So maybe let me hand that to you.
Yeah. So in terms of the pipeline, these are super important questions. So the strongest projects and the ones that we're really excited about have often a partnership. So there's an organization that has long-term on-the-ground experience, has relationships with communities, has relationships with government, has demonstrated experience in doing the activity of actually planting or maintaining forests and providing alternative livelihoods. Typically, that hasn't been through a carbon project, right? It's been through grants or other sources of funding. And there is, so that entity combined with a carbon project developer who brings the expertise in actually going from ensuring that those activities on the ground are translated into verified, validated carbon credits that are sitting within a registry through one of the global standard organizations. That's obviously incredibly important. And so to the to the question of how we're ensuring permanence and biodiversity and other criteria, the very baseline is that we're obviously working with projects that will be selling verified credits. Now, we certainly believe that the standards are sort of a minimum. And so we're also looking at aligning with some of the other emerging guidance and principles coming out from groups like ICBCM, VCMI. Our advisor is sitting in a lot of those conversations. And so, aligning with those and ensuring that, this is indeed, prioritized and measured and told in a way, because there is a premium for doing these things right. And so we really are looking to also capture that.
Great, thanks so much, Kate. And I think this also already addresses the second question we got from Elodie. Very, very important, what are key demand side? But I think not only demand side, also supply side integrity challenges that you address. I think you've referred to that. Maybe you can also just address it a little bit more in the chat. But thank you so much for this overview, and again, very exciting, fun concept, and looking forward to next steps there. But with that, I am going to move on to our last, but certainly not our least important instrument of this year's cohort. So we have our instrument from the zero carbon building stream. So we're moving from nature to the built environment again, the green affordable housing finance, which is presented today by Ian Shapiro, who is the Chief Executive Officer at REL. And so Ian will tell us a little bit more about their plans to solve the issue around the green housing market in Africa. So Ian, the floor is yours.
Lovely. Thanks, Barbara, and thanks to everyone. And it's quite humbling to come in after the 6 high-quality instruments we've already had, and I hope we're going to hear explain a 7th high-quality instrument that we're super keen gets support. This is about green affordable housing finance. I'm Ian Shapiro, and I'm the Chief Executive of REAL. I want to talk about the 3 big challenges facing the planet today and how they come together. So the first one is urbanization. So we know that there's another 2.5 billion people moving into Africa and Asia's cities by 2050. So it's a huge amount of humanity being added to our cities. The second big challenge is poverty or inequality. And we know today there's about 1.5 billion people in substandard housing. And we know if we don't change what we're doing, that number will be over 3 billion by the end of this decade. And the third big challenge, and of course, this community knows all about this and all the instruments have already been talking about it, is of course the climate crisis. And how does the climate crisis connect with those other 2 pieces and green affordable homes? Well, if I tell you that 70% of the buildings that are needed in Africa and Asia by 2050 have not yet been built, we really need to let that number sink in, 70%. We know that nearly 40% of greenhouse gases come from the built environment. And here we are, we've got a huge amount of humanity moving into Africa and Asia's cities, and those buildings have not yet been built. So we need to bring a combined solution that looks at the poverty challenge, the urbanization challenge, and the climate challenge, and brings them together. And here is the solution that we're talking about with green affordable housing finance. So REAL, we've been working at this cross-section of issues for over 30 years. We've built thousands of homes and invested millions of dollars. We know what can work, and working together with the lab has been brilliant over recent months to create this new instrument. And it's innovative and it's exciting because it's the first time ever that we've combined a supply side intervention and a demand side intervention. So that's where the instrument itself comes in. Now, what do we mean by this? Within green affordable housing finance, we have 2 facilities, an enabling environment facility and a guarantee facility. So to quickly talk you through those, these are on the enabling environment side to ensure that we can stimulate the kind of green building that is necessary. So how do we, knowing that there's 70% of buildings to be built, how do we make sure that they're done in a green, climate smart way? So we have international certification with EDGE, but we're also using a range of tools such as artificial intelligence tools to show that we can de-risk clients so they can move into these homes. We know that we've got many credit-worthy people living in the informal sector, but they're not able to step into the formal sector. They're living in substandard housing, they're paying rents to an unscrupulous landlord, and there's no green homes for them to move into that can provide safety and security. So we want to deal with both the supply and the demand. And that's where the guarantee facility comes in. Here, we're going to be establishing with local finance institutions guarantees which gives them the confidence to work with developers building green homes. We know the demand's there. What we need to do on that side is the supply, and then a mortgage guarantee, which again says we're going to take the risk on those low-income informal sector workers and say we can build up a track record using our AI-enabled toolkit to de-risk them and show that they are ready to come into the formal sector. This has huge knock-on benefits in terms of girls being able to go to the toilet safely at night, education, health, water, sanitation. Crucially, green affordable homes at the mass market point are also brilliant job creators, green jobs for green assets. So what's the impact of this? Well, the impact within the initiative we're talking about now, you can see on your screen in front of you. Yes, homes for 11,000 people. Yes, thousands of embodied CO2, tons of embodied CO2 not being emitted. But crucially, this fund itself can generate a self-sustaining model. We can demonstrate that this can really deliver a multiple long-term solution that can deliver at scale. This investment alone, where we're looking for $15 million, will generate $400 million into the green affordable housing value chain. So that's $25 for every dollar that's delivered. So the type of funds that we're looking for, we're looking to you to help us, give us advice, and ideally give us some resources, is in 3 different areas. We're looking for some concessional debt, we're looking for some returnable grants, and we're looking for some non-returnable grants. That's because we know that $15 million is the right number to get this going, to kickstart this opportunity. Clearly, the big opportunity here starts in Kenya, but is ready to go on a much longer journey. So we're going to start this in Kenya, we're going to deliver these homes, but then we're going to have that opportunity to roll this enabling environment facility and this guarantee facility into new markets. So Kenya alone has 2 million affordable homes needed today, and that's growing at 300,000 homes a year. So there's a huge opportunity just in Kenya, and that this will provide a self-sustaining solution to. But what we want to do is then take that beyond. The financing I already talked about, so we're looking for $15 million, and we're able to blend how they could work together, and we'd be keen to talk to anyone able to provide any of these 3 contributions. And we have others who are interested in other elements as well. So we'd love to bring that together. And this is the $15 million ask at the moment. This green affordable housing finance is an investment-ready solution. It looks at those 3 big demographic shifts. It looks at the urbanization challenge as it faces us today. It understands that people on low incomes are investment worthy and actually need a home from which to provide the opportunity and a platform for their future. And it must respond to the climate crisis. We must incentivize green building. These buildings are going to be built. We've got to ensure they're done in a climate smart way. We're investor ready, we're market ready, and we're keen to work with you to move this off the ground. Thanks very much.
Great. Thank you so much, Ian, and thanks for a very good overview here. I think as we're just waiting for questions from the audience, I think I just have one follow-up question. I think you very nicely present that this is a kind of a global solution, but how exactly are you intending to apply it to the local context? I think specifically in the context of the Kenya pilot. So how are you thinking about integrating it into the Kenyan ecosystem for the pilot? So maybe a little bit more specificity there would be helpful.
Sure, Barbara. I think that's right. So we know that this instrument could work in multiple locations, but it's got to be targeted to that local community. So if you look at the Kenyan context, Kenya, a country of 55 million people, has less than 30,000 mortgages in the whole country. So we know that there is a blockage in terms of that offtake solution. So how we're going to work with that is to use the governments have got what they call their Big 4 agenda, which includes affordable homes. So there is the right enabling environment. What we're going to do is de-risk that investment with the guarantee facility. So that's how we're going to be targeting to show that there are people, they're not sleeping on the streets, they're paying rent every month, they are credit worthy, they've just not been able to move into a green home. And so that's really how we're going to target it in the Kenyan context.
Great, thank you so much. And there's another question from Jennifer Wong again, and I see that Patrick is already replying just on whether you're planning to partner with any local financial institutions who may also be doing local lending for affordable housing. So let's just see whether you want to kind of reply to that live, and then we will move on to the final segment of this webinar today.
Sure, Barbara. I mean, just to say that clearly what we're trying to do is demonstrate that this is a viable proposition to deliver at scale. And clearly what we want is a financing structure that works with local financing institutions. So clearly the key here is to take out the foreign exchange risk and work with local capital markets. So absolutely working with the local Kenyan financing sector.
Fantastic. Thank you so much. Very important point, Ian, to end on. So thank you very much. Thank you very much to all of you. We are just about out of time, but we wanted again to thank all of you for supporting this year's class of lab entrepreneurs. As I said at the beginning, we need your help to get them to the next level and to achieve the impact that you've seen that all of them really can have. Each team has provided their contact information, so we encourage you to contact them directly, but we are also launching a Zoom poll right now just to gauge interest, and it's even popping up here. And so we would really ask you just to take a moment to respond if you would like to learn more about one or more of today's instruments. And believe me, they are all, as you've heard, very eager to hear from you. And after going through the lab process, they're really ready to hit the ground running to implement these ideas and really kind of foster action on the ground. You can get additional information on the lab's website, including the contact of each team, and we're sharing that link in the chat right now as well. So let me just give you a second to do that. And again, please express your interest. And maybe just as a final message, the lab will launch the 2023 call for ideas on Friday, and it will extend until the end of December. So we are looking for a ninth cohort of lab instruments and lab entrepreneurs. Information about the submission process is available on our website. The link is on the screen here as well. So we are again looking for innovative finance solutions that can unlock investments to tackle the climate emergency and present investment opportunities for a sustainable net zero economy. But with that, let me again thank you all so much for your attention and for your interest today. And huge thanks also to you, Vikram. It's been a pleasure co-hosting the webinar again with you today.
Thanks, Barbara. It's a pleasure as always.
Fantastic. Well, that's it for the lab's demo day. Please make sure you follow the lab and subscribe to our newsletter to get the latest and greatest on climate finance innovation. And again, thank you all for your interest, for your support, and see you the next time. And hopefully see many of you soon in person. Have a wonderful day or end of your day wherever you are. And thank you very much.